Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you, as usual, each and every week with our series of expert online panels. We have another great one lined up for you today. It's Patrick Karim and Kevin Wadsworth of NorthstarBadCharts.com. We're going to be getting their view on the commodity space through the perspective and lens of technical analysis and charts, something I think is not discussed enough. So very excited to dive into that. Gentlemen, thank you for coming on the show.
Thanks for having us, Jesse. It's great to be here.
Yes, thanks, Jesse.
Yes, great to have you both on. So I'm going to kind of throw the ball in your court for this interview because I know you guys have a lot of cool charts. You spend a lot of time working on this. So let's start off. We'll go through some different asset categories. Before we dive into commodities, I wanted to talk about the broad market and the economy. Are there any charts you could show us that you think are fascinating that investors should be paying attention to?
Yes, Jesse, do you want to go first, Pat, or do you want to show the...
Well, yeah, I'll show you one chart to set like really the macro landscape of like which assets, macro assets are fighting it out, duking it out, which will carve out the charts that everybody, all your investors, they like, how come my uranium's not going up or my miners, whatever. This chart's going to set the stage for that. And I think after that, Kevin's going to show you some actual macroeconomic charts and adding more color to all this. So I'll share my screen right now, Jesse. So I refreshed this chart recently. Essentially what you're looking at, guys, is 140 years, and that's the beauty of trading view there. That the data feed goes forever. 140 years of US stocks, so essentially the SPX priced in gold. Because we have to remove this fiat illusion, right? That's step number one, because if you have a depreciating fiat, practically everything, of course, is going to be cyclical cycles within it, but everything's going to nominally go up, right? I think your viewers, they're attuned to that, right? They're aware that, like the SPX is not 100 anymore, it's like we're in the thousands. It's because there is growth, but there's also fiat purchasing power destruction. So when you price it in real terms in gold, it just reflects purchasing power fluctuations. You get in real terms, right? You often hear people say that. So here it is. There's macro cycles. So when you zoom out, I know it's a lot, 140 years, guys, but you got to be aware, because if you could time it, or if you understand where you are in this macro cycle, it changes everything, right? It's going to make the difference between your miners going anywhere and sucking wind, or them just like rocketing upwards, and then you could buy the dips in a more safe manner. Here I have the 1929 not the dot-com bubble, but I don't know, is there a name for that blow off top we had in the 1930s?
The stock market crash that came immediately afterwards.
Yeah, everybody knows.
Wall Street crash.
The Great Depression. Everybody knows the Great Depression, but there was a run up. I know gold was pegged, guys, but gold was pegged but unpegged. People they think gold was pegged and never moved, right? So eventually they had to account for purchasing power destruction. Even when it was pegged officially, there was too much pressure. They were printing maybe too much money to finance wars and stuff like that. They actually had to unpeg gold back in, I think, in the mid 30s for the war coming up. But here you have the stock market crashes, price in gold. And after that, here below here, I have the 7-year rate of change. So essentially 7-year rate of change is telling you, as of today, 7 years ago, how much did the instrument fluctuate? And as that unwinds, the rate of change unwinds, you're heading into what is called like a bear market territory. Like the rate of change is not able to increase, you're decreasing. And if you combine that with top and a trend line break, you're increasing the odds that gold will outperform SPX. So you had one here in 1931. You had one in 1970. Here you see how the stock market's outperforming gold, guys, but the rate of change is not able to outpace. So that's step one, right? Create that possible bearish divergence. But as soon as you have a topping pattern, a horizontal line breakdown, a rising trend line that broke down, and the rate of change starts dumping into negative territory, man, that's a new bull era for precious metals, right? Because Kevin is going to show you a chart later that gold, uranium, silver, oil, all these instruments, they love this, right? They love when SPX breaks down versus gold. until this bottoms. Of course, it doesn't go up forever. There's a bottom here, and after that, there's a reflation in SPX. And look, we had here's a .com bubble one, a top, rising trend line, breakdown. But look at the momentum here. It kept going up, up, up. And after that, as the stock market can't do new highs, it falters, rate of change plummets, cycle repeats over and over. And I'm taking a deep breath because look where we are today. Here, the momentum went just crazy up to 2020. But now the momentum, the 7-year rate of change, it cannot outpace, it cannot create higher rate of change. And the price is very close here to, it's hogging this angled rising trend line. It's close, it's testing it. Here's a bigger pattern, less steep, more horizontal looking line, which is going to create a more important signal later on. But we're there again. The setup's there, Jesse, for a macro landscape change. It's not quite confirmed yet. This is critical. This has to be confirmed for to really to go to say load up on everything. But if there ever was a chance to have a change in in the kings of the macro assets, it's right happening right now.
Well, that's why I love your guys' work. You always take a unique approach, but a very practical one. And US stocks priced in gold is not a chart you see very often, but one that, as you pointed out, has a lot of insights that people can be looking towards. Kevin, what chart did you want to show us in regards to the broad market and the economy?
Just to pick up from where I left off there, and the fact that we're close to seeing that breakdown for the stock market versus gold and what that might imply for precious metals. There are lots of other pieces of evidence across similar ratio analysis charts that are actually some way ahead of what's happening with SPX versus gold. And this is one of them, along with actually gold versus the US dollar index. This is the US M2 money supply to gold ratio. And when precious metals are in a bull era, and when precious metals are in a bull era versus the stock market as well, what happens, you can see this very long downtrend on the chart here. When the chart's moving to the downside, what it means is that M2 money supply is underperforming gold, or the other way around, gold is outperforming M2 money supply. Now, over the past 10 plus years, 10, 12, 13 years, we've seen a pause in this huge downtrend, and that pause has formed what chart technicians refer to as a rising wedge pattern. Now, these rising wedge patterns, if and when they break to the downside, are a bearish indication. They suggest that a new trend is developing that will lead to a prolonged period of downside action on the price chart. And back here in 2022, when it started to break down, I started posting on social media that it was, and on our website, of course, that this is a breakdown on the chart, which is indicating good things for gold. Now, since I put that information out, gold has risen $800 so far. The thesis was, of course, that this chart breaking down was a strong piece of evidence to suggest that gold was entering the very early stages of a new bull market. Of course, we were way below $2,000 at the time, probably somewhere around about $1,600, $1,650, $1,700. And of course, we've moved up to the area near $2,400. So a big move, just as this ratio has dropped to where it is now. But over time, eventually, I expect this to move significantly further. Now, this is all with a backdrop of something that's very, very important, and I think your listeners will be well aware of this. Now, perhaps I should point out at this point here is probably a good time to mention that technical analysis isn't some kind of voodoo with kind of geeks sitting in front of a computer screen just drawing pretty lines and making stuff up. I mean, my background is in military meteorology, and we analyze the Earth's atmosphere in much the same way. And what I've noticed as an ex-military meteorologist is that the market movements, price charts for whatever it happens to be, whatever instrument it is, and in this case it's the 10-year yield, has a cyclical nature to it, and that cyclical nature really comes back down to human behavior and investment cycles, and the economy itself operates on a series of cycles, and those cycles are driven by capital flows, capital rotation, and all that kind of stuff. which is great, but you can identify that using these charts. Okay, I'm just going to put the moving average on here because it was missing. It needs to be the 12-year, which is 48 period on this quarterly chart. So I'll just do that for you whilst I'm thinking about it. Okay, so this chart here, what it does, identifies shifts in capital rotation, fundamental shifts in this case, government bond yields. Now, what you'll notice quite quickly is back in the late 1950s and 1960s, the 10-year yield broke out above a very important resistance line, began to move upwards, and at the same time, 12-year moving average, having been moving down for decades, started to move to the upside. So what that's telling you is there's a trend change taking place during that period in the late 1950s into the 1960s. We'll know that during the 1970s, inflation was roaring through the economy, bond yields were rising, interest rates were rising. And I think people sometimes forget that gold had its biggest bull run ever during this period, where gold doubled, then it doubled again, then it doubled again, then it doubled again, then it went up some more. Okay, now you can imagine with a starting point of $1,500 to $2,000, if gold doubles, then doubles again, then doubles again, then doubles again, then you don't have to be a genius to do the mathematics on that and work out where the gold price might be. But the important point to notice here, and you just have to learn from history. I think here it's as simple as that: pattern recognition and learning from history without delving too deeply into the mechanics of it. The 12-year moving average has turned up, but only, well, I was going to say only the first time since the 1950s. So you're talking about what, 70 years. It's the first time the 12-year moving average has turned up. So something fundamental is happening here. And the chart pattern that we found ourselves in was a descending, expanding wedge. Now, okay, that sounds all very geeky and so on, but we saw this break down during early 2020, where the bond yields, the 10-year yields, fell very close to zero. That was a false breakdown. It was instantly identifiable on that chart pattern as being a false breakdown. It was unsustainable, and the fact that it was such a deep false breakdown on such a massive chart over 40 years meant that the probabilities were very, very highly in favor of a violent upside reaction and a breakout of the entire pattern. So back in early 2020, I went on to our social media channels and all the rest of it, sort of shouting to anybody that would listen, was that there was very, very strong evidence that bond yields were going to move up to at least 5%. That was the initial target area. Met with a lot of skepticism at the time, of course. But, with the benefit of hindsight now, we can see that's exactly what's happened. And we moved through this pain line. And that's important because this line here was there for a reason. If you think about government debt and debt to GDP, that resistance line, that red line that goes all the way down the top there, every time the 10-year yield hit it, it was rejected, hit it, rejected, hit it, rejected. And there's a reason for that. Mathematically, there's a reason for that. You don't really need to think too much about the fundamentals. This is all about mathematics and debt sustainability, because debt to GDP was rising from 31% up here to roughly 30% down here. So debt to GDP rising, outright debt rising. So to service that debt, the yields, the interest rates on that debt need to be contained more and more and more. In other words, the interest rate has to fall and fall and keep falling to kind of keep control of the economic situation. Now we've broken out above that pain line, as I nicknamed it, and we're up in new territory here. We have broken the pattern of the last 40 plus years, and we're now in a region of this chart that is problematic mathematically for long-term debt sustainability, unless one part of this equation can be managed. And the part of the equation I'm talking about is that debt to GDP issue. And it's a mathematical problem unless GDP can rise rapidly. Now, I don't know if everybody realizes this, but GDP is actually money supply multiplied by money velocity. If you overlay the chart for money supply times money velocity onto the GDP chart, it's exactly the same chart. They are identical. So what I'm saying, I suppose, from this chart is that the only way out is for GDP to rise rapidly, which means money supply multiplied by money velocity to rise rapidly. And I probably don't need to explain in too much detail what that might mean in terms of inflation, in terms of commodity prices, in terms of gold prices, in terms of PPI, CPI, all of these things. So the conclusion from this chart, for me as a mathematician and a sort of scientist point of view, is that we've got serious issues with debt sustainability. The answer to that is to increase GDP. Increasing GDP is going to put upwards in pressure on inflation, commodity prices, precious metals, and this all feeds into the thesis that there's a rotation taking place at the moment in very early stages of a rotation away from stock markets and towards commodities and precious metals.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Very fascinating breakdown. I'd like to touch on silver for a moment here. Are the same drivers that are driving gold from a technical point of view also driving silver? How correlated are the two assets? What can the charts tell us about silver right now?
I was going to show you this chart. I'll cover it real fast, but I think I have a better chart to tell people, like you hear it often, how come silver is not back at all-time highs? Gold is, it's above. How come there's a built-in catch-up move for silver, you know? But those are some, while objectively they might look true, there's some fallacies embedded in that type of reasoning. And I have some actual charts going to show you that people should, everything is priced properly right now in the markets. If you think something's not priced properly because you're looking at two different charts and comparing them in your head, say, hey, those two charts, they should match, but they're not. And then you're in your head, you're jumping and you're saying, hey, those should match. There's a built-in catch-up. That means you're not looking at the good charts. You're not, charts that are correlated will look correlated. If they're not correlated, there's no such thing as a catch-up move. There might be one, but the markets are pretty smart, guys, and thinking that the market always got it wrong and there has to be a catch-up is you thinking that the billions of dollars sloshing around are like totally off base. So maybe I should start with that chart instead of this one. Let me just pop it up. It's that charts one, and it'll be silver tracks, because I've done a whole bunch of these. And okay, here. All right, I'll show you this one, guys. Again, a lot of data. The black line is gold adjusted for inflation. And then I overlaid the silver chart, and you'll see the track. And you'll see that the gold adjusted for inflation is not at all-time highs, right? Well, this is an old chart. It's before it broke out, but they're tracking practically the same, right? Gold is almost at all-time highs versus inflation. Silver's starting to track, starting to move up alongside it. But that's what silver is, guys. Silver is a derivative play on gold's capacity to outperform inflation. The cost of holding gold, the carry cost, the inflation burden on gold, that's what silver tracks. So if you want higher silver price, if you want silver to be at all-time highs and break out, you need gold to do the same thing versus inflation. So that's one of the big charts that I show people every time I hear that silver, you know, it's lagging gold. It's doing exactly what it's supposed to do. So if you want gold, the silver prices to go higher, you want gold to keep outperforming inflation. And yeah, it was a big turnaround here. See, yeah, that chart kind of led the breakaway. Oh man, almost 1 year, Kevin, since I did that chart, July 4th, 2023. But you know, there was indications that thing was going to move upwards. And it's the same thing for miners. Miners track gold versus SPX. So I could overlay, of course, there's outperforming miners, you know, but the mining indices, they track gold versus SPX there. I'll do it right now for you guys. So let's say I do gold, XAU USD divided by SPX. So that's, And a lot of people, I could put, what do you want me to put? I could put the ASA. ASA is the Precious Metals Fund since 1968. And I'll put on log scale. And look, guys, I'll just zoom out and you'll see that this is gold versus SPX. This is the ASA chart. And as I'm moving the ASA chart up and down, you'll see that it's tracking gold versus SPX. So as gold versus SPX has not done new highs, it's not breaking out yet. Here, the same thing's happening for the miners, right? They're going to get a lot of tailwinds, and that's why we often mention we want to see gold versus SPX above 0.5. When gold is worth half of SPX, it's going to be close to a technical breakout, almost a horizontal breakout line or slightly angled one, which we give more value to those breakouts, right? It's way more important to have a horizontal line breakout than a steep one, right? There's less downwards momentum when you have these horizontal line breakouts. So that's what the miners are. Again, the miners are properly priced. When gold's able to outpace SPX and those capital flows, and that goes back to the first chart I showed you, your miners they're going to do fine nominally, right? So that's what all this hang up is about. You want to really make sure gold outperforms SPX. And it leads me back to the chart, the first chart I had queued, which was the gold, which is the silver chart. So everybody wants to know what's happening nominally to silver. And let me find it. Silver is hitting some very identifiable resistance since the 2011 to 2013 top. There was a breakdown. There's this concept called either pivot lines, or we like calling them walls. Previous support turn resistance. So when you have support, and that breaks down, as soon as you're below, it converts that support into resistance, right? That means all the bag holders here, they're trapped. And if ever the price, even it's years later, it comes back to that level, people say, oh my goodness, we're back where I got trapped. I want to break even. I don't want to tell my wife, like, I lost money. And you sell, right? They sell. So every time you try to go up above, if there's still sellers, the price goes back down until that wall, you eroded it, right? Like water trickling down, hitting it, and eventually it breaks, and then the dam breaks. So we need that $28 level to really, really break. And look, it was crazy on the shorter time frames here. It was silver squeeze all over again about 2-3 weeks ago. Remember, it's like silver's going bonkers. It was melting through that monthly defined resistance on the shorter time frames. But the higher the time frame, the more important the breakout will be. And look, we're at the end of the month now, and silver's back below this. It's a wick. I don't like it. I don't like that volume, guys. I'm sorry. That volume, it's telling me that it's blow off top type volume. It could have been breakout type volume if the price would have closed above 28, but it didn't. So now you have to see that as people that are trapped, right? Everybody that bought at 28, 20, like on the smaller time frames, these guys now, they're becoming resistance, because if the price goes down and the price starts going back up, they're going to want to break even. It's a psychology, right? Like if the price doesn't rocket in your direction, you can say, oh my goodness, I got lucky and I'm going to exit. So, but it was very good though. There was a trend line here break, or horizontal, slightly angled one. So that was pretty good. There was a breakout, but now this 28, guys, is the level to watch. You want a solid monthly close above that. But right now it's just there's a correction happening there for gold, for silver on the shorter time frames, and you just look. All tops start with bullish looking consolidation patterns that fail. All tops start like that. So you got to wait and hope that whatever correction we have on the short time frames is just nice and resolves, over time. And after that, you have to wait. But jumping the gun, as soon as you realize you're in a correction, you got to step aside, or you could pray and hope. But look, why pray and hope? It resolves upwards, and you don't want to get trapped again there. You don't just don't know how long there that thing's gonna move sideways.
Absolutely. Wow. Excellent breakdown once again. Kevin, did you want to move on to uranium now? Is there anything else you wanted to add to the silver conversation?
Yeah, there's a gold chart as well. So I suppose taking a quick look at gold before looking at uranium would be a good thing. And this is the gold roadmap that I've put out just very recently to try and visualize for people what I think is a high probability path for gold over the next several years. So I put a forecast out back in 2019 when gold was down at around $1,300, and the forecast was that it would hit $2,000, trend sideways for about 3-4 years, and then in round about now 2024 would break to the upside. People can see that forecast on my social media channels, of course, and so that particular gold forecast needs refreshing and updating. That's kind of all history now, and that's happened, and that was all based on the cup and handle pattern and other sort of technical analysis techniques that led us to believe that there would be a painful long consolidation. We broke out from that, and the 2000 area has now switched from being resistance to being support. Okay, so we've moved up, as I said, to around about that 2,400 area, the high 2,300s to 2,400. Now there is some natural resistance coming in between sort of 25 and 2,700, that kind of region, and that's pretty consistent with some other techniques, including Fibonacci extensions and pull, flag, measured targets, and all that kind of thing. You can see this flagpole here. This is flag, and then the measured moves. So there are a number of techniques that give targets anywhere between sort of 25, 2,700. We haven't quite reached that 25 to 2,700 area yet. Now we're seeing quite a bit of weakness with gold pulling back as I speak, down below, I think, below 2,300 yet. I haven't looked in the last hour or so, but I think the question right now is whether we backtest the support in the 2,000 to 2,100 area now, or whether this little pullback doesn't go very much further before accelerating towards that target area. It's pretty much a coin flip, I think, whether it backtests that area now or extends higher over the next few weeks before pulling back. But either way, I'd be surprised if we don't come back for a final sort of monthly defined back test of that sort of breakout area. We've already tested it on the daily and weekly time frame, but not on the higher time frames. And given the size of this pattern, it would make a lot of sense if we did come back down to test that area.
Hey, Kev.
Yeah.
Sorry. I just saw Jesse there. He just sold all his gold while you were talking. How'd you do that, Jesse?
Yeah, you can't see my hands. I'm clicking. I'm putting in sell orders.
But the long-term picture, given what we've been talking about with the capital rotation, the stock markets, and all the other sort of weight of evidence, is that pullbacks, despite them being, perhaps sizable pullbacks, this is a 15-20% pullback for gold, could even be a bit more, sort of towards 25%. It's not unusual. And silver, of course, moving 30 to 40% to the downside is perfectly normal price action in a silver bull market. It happens multiple times in every silver bull market. So don't get stuck on the idea that silver can't move from 50 to 25 before going up to 100 and coming all the way back down to these big drops are normal for silver and for gold as well. So you can see here we've seen some big drops in the past, even in the bull markets. You see these 15-20% drops that take place over a period of several months. So it's nothing new. It's perfectly normal price action. But in terms of the long-term targets, I would be somewhat surprised if we're not at least at the sort of area around $8,000 to $12,000 by the end of this decade. So the technical analysis techniques that I use sort of suggest that 8, 10, 12,000 is an entirely reasonable target. In fact, you can see this green dotted line here is an extension of the 3-year moving average, if I was to put it on the chart. And by measuring the distance above the moving average, you can get a target, a reasonable target, and somewhere around 40% above the 3-year moving average is a perfectly reasonable target. So, and if we move to anywhere like 100 to 150% above the moving average, as we did at the end of the last bull market, then, as I say, 12,000 or so is entirely possible. So that's the general roadmap that we've got. It replaces the one that I put out in 2019. And looking at uranium that you mentioned there, the uranium roadmap is still completing its cup pattern or arc pattern, as gold has already done. Gold, of course, reached its arc target of $2,000 several years ago before forming the handle on that. So uranium has got sort of basing pattern, same sort of recovery pattern, being guided by a perfect geometric arc, also the 3-year moving average. And what's taking place at the moment. Looks like pretty standard consolidation pullback in the middle of a resistance zone. Of course, we broke out above the $24 area, which was sort of a stage 2 breakout. We broke out from this flag pattern here. So the initial surge, for the uranium, this is URA, by the way, it's the URA ETF, Uranium Miners ETF. The initial surge, the long pullback, secondary surge, and it looks like a normal bull market consolidation. Unless we fall below the 3-year moving average, I don't really have any major concerns for the uranium sector. It's all looking pretty good and pretty bullish at the moment. So the long-term target, or the longer-term targets, are up towards the top right-hand corner of this arc, which will put us probably above sort of $90 or so. But currently, the next stage of the move probably puts us somewhere near $50 to $65, that sort of area. So it's all looking pretty bullish for uranium. I know there's perhaps some people getting a little bit frustrated at the moment. The last couple of days we've seen some nice moves for uranium miners, but it all looks perfectly in line with our projections and our forecast.
Yeah, and I think you get that frustration. A lot of that comes from social media, the fact that news gets transmitted instantly, people are checking the price every day, people buy in, seeing all this bullish froth on Twitter. Like, I'm sorry, I'm part of the Twitter uranium community and I love it, but it's not the place you want to go for investment advice or for any sort of information about uranium, because it's literally just bullish memes and people talking about how uranium's going to rip and go to the sky. And so people buy into these things, and very often they don't position size correctly. They YOLO into junior explorers with no discovery or something, like companies with no path to clear production. Then they wonder why their portfolios in the
There's
red.
a very good point you just touched on there, Jesse, which I'll just mention. Risk management and managing your position size using sound risk and money management protocols is absolutely essential in this kind of thing. And by the way, technical charts, if you're not used to looking at them and you're more used to thinking about the fundamentals and weighing up the fundamental factors, just bear this in mind. The technical chart is the physical representation of every known fundamental factor. So I could spend many, many hundreds of hours researching the market, or I could look at the price chart, and the price chart has kind of done that for me, because the price chart tells me where the support is, tells me where the resistance is, tells me where the volume support is. It puts all that information very conveniently down into a nice, pretty picture for me. And if you can learn the language of technical chart analysis, then you can learn to interpret, but really what the fundamental stories are for all of these instruments, whether it's uranium or gold or silver or the stock market. The technical chart is just the physical representation of everything that everybody knows, all the market participants know about the fundamental factors.
Great. Well, did you want to move on to energy now, guys, just in the interest of time? Patrick, do you have anything quickly that you wanted to add to the uranium conversation before we dive into energy?
Yeah. No, it's like everybody just match your time frame with the chart. So if Kevin's showing you a monthly candle chart with like 20, 30 years of data, it's like, you look at Twitter and there's a 5% down day in uranium or 10% up day, that it's irrelevant. You have to look at the time frame to match your expectations, or else you're just dead man walking, right? There's going to be you're in an uptrend, a secular bull uptrend, and then there's a correction on the daily chart, and then you're going to sell everything, and then after that it's going to rip higher. Everybody's went through those emotions because they're too close to the steering wheel, right? So if you're a day trader, fine, look at the shorter time frames. But if you're an investor and you're trying to catch these longer term rides, then you have to zoom out on a higher time frame.
Yeah, absolutely. Let's take a look at the energy sector. Obviously, from a fundamental perspective, I think it looks very good. However, you have the chatter out there that, well, we're going to have a global recession and that's going to crush the demand for oil. So I'm wondering what the charts are telling you. I see here you've got a crude oil, SPX priced in crude oil. That's interesting. Walk us through this.
All right. Well, again, same exercise I did with gold. You want, in a bull market for oil, you need to be outperforming SPX. You will not have a bull market for oil if you're not outperforming SPX, or it won't be as robust. You gotta beat SPX. That's where the money goes. You have to beat that. So I hear same thing. 145 years of data. That's all fine. Some tops here, sideways, rising trend lines. Same thing, like I explained to you with the gold chart, the 7-year rate of change. When that thing is as SPX goes up, higher highs versus oil, but the rate of change, lower highs, that's some possible bearish divergence. And once that cookie crumbles and you have a technical breakout here, the bottom pane is the actual oil chart. And then you have a technical breakout for oil while it's breaking out versus SPX, while the rate of change is going negative. It's like the weight of evidence, right? Check mark, check mark. Okay, I'm good. So here we had the first like a mini bull era for oil back in 1913. It ran. Same thing here, late 1940s, early 1940s, it ran. But here's where it gets interesting. We had bigger runs here in the 1970s. We had a crazy run here. This is the Nifty 50 topping, breaking down versus oil, going the 7-year rate of change for that ratio plummeting. And then oil just went bonkers in the 70s, like huge. And I'm sure some people said, I can't go up that high. It's going to break everything. Well, look, if they're destroying your purchasing power, you gotta let that thing, ride up the oil price. And it's also the oil price relative to SPX, right? If it's overvalued versus SPX, that means there's a lot of fuel for it to reset, right? And it resets so much here. It's crazy. In 1980, oil had retraced 1920 there. So that means like for 60 years, it's just was simply retesting lows or highs it did versus SPX some 60 years later. Here's the next run for SPX versus oil, but look, breakdown from the top, lower highs, momentum unwinding, and a beautiful technical breakout here, higher lows, and here horizontal plane, higher highs, breakout. All the words I'm using, it's like the observations, like the bullish observations. You guys should be check marking. He's saying horizontal breakout line, check, higher lows, check, higher highs, check, breakout versus or SPX breaking down versus oil, check. That makes a bull run, a more powerful and sustained bull run likely. And again, same thing again, SPX resets versus oil. And then after that, the whole cycle repeats again. Here, blow off top for SPX versus oil. Remember, oil was negative. I thought about filling up my pool. I have a 60,000 liter pool. I was thinking about filling up with oil there. It's like, I wasn't thinking straight. I should have just like bought oil futures, but in my crazy mind, I said, let's just fill up the pool with oil.
Sure, the kids would like that, Pat.
It was negative, the price. Like, how did that make sense? What, they're giving it away? I never understood how you could have negative oil, but I guess like contango and all that stuff there, backwardation, we were there.
And I think there was oil tanks filling up to the point where they no longer had storage in some places. I think in Cushing, Oklahoma, where so much of the oil is kept, that there was actually a storage glut, so they could pay people to take it off their hands for a brief moment in time.
Crazy talk. But in the abyss of it, people are still doubting it. It's like, oh, maybe I'll stay negative forever. It's like, like what? You don't think it's crazy because at tops, we always think it goes up, and at bottoms, we always think it goes down. It's human nature, unless you're looking at charts to see where the turnaround is, right? And look at this massive top, or I could say possible massive top for SPX versus oil. So we have a rising trend line here, 1, 2, 3 touches. If that thing breaks down here, that's a possible massive head and shoulders top for SPX. And if that breaks down, that's going to mark a new bull era for oil. And look at that, the move, $300 oil is not off the table. Easy. The momentum is breaking down. The setups look totally there. So if there's a market sell-off now, the recession, but once that's out of the way, my goodness, the purchasing power destruction, the like whatever money they have to print to save the US stocks the next times they tumble is gonna catapult oil. Like if it ever closes above this breakout line, I think it's maybe that at 115, 120. If it goes above that, goodness gracious, Jesse, there, it's like hang on to your oil stocks. Not financial advice.
Yeah. Well, that's exactly what I'll be doing. Well, guys, this has been an incredible conversation. I love your unique approach to charting, and you bring so much wisdom and knowledge to the game. I think people should be paying more attention to just technical analysis in general, as well as the work that you guys are doing. So why don't you tell us about NorthstarBadCharts.com, what it is exactly you do there, where people can find it. Fill us in.
Yeah, it's just coming up to 3 years of NorthstarBadCharts.com at the moment. We're both on Twitter, of course. You can find me at NorthstarCharts on Twitter and Pat's at BadCharts1 on Twitter. But we were just getting a little bit inundated with requests for information, all that kind of stuff. So we've got a smaller audience on our website, which makes it more manageable. That's our northstarbadcharts.com, as you say, and we cover everything. We're not sort of tied to gold or silver or uranium or anything in particular. We're tied to technical analysis, and we follow the evidence for the technical analysis so that we always steer our members and subscribers towards whatever it is that is having good looking technical charts and whatever's outperforming at the time. So yeah, you'll find much more of this kind of stuff on the website, lots of podcasts, and we've got a celebratory 2-day special offer actually for anybody that wants to join us over the weekend, noon Friday to noon Sunday, 50% discount. So yeah, why not treat yourself?
Great. Well, I'll put a link in the description below to northstarbadcharts.com, as well as both of your Twitters so people can follow you there. Gentlemen, thank you again for coming on the show. It's been an honor.
It was an honor for us, Jesse. Thanks, man.
Yeah, the honor's all ours. Thank you.